We all know money makes the world go round, but have you ever really stopped to think about how? I'm not talking about paying a friend back for lunch. I mean the huge, globe-spanning transactions, the ones that let giant companies and even governments operate everywhere at once. Well, that's what we're going to dive into today, the wild, high-stakes world of international banking.
So let's just start with what seems like a simple question. How does a bank in, say, Ohio go about lending money in Tokyo? I mean, it sounds straightforward, right? But just think about it for a second. You've got different laws, different currencies, totally different kinds of risk. Answering that one question is pretty much the entire reason international banking even exists. Now, you'd probably assume that American banks have always been these global giants, right? But here's the thing. They totally weren't. For a long, long time, they were actually pretty late to the party. European banks had been playing the global game for centuries, while U.S. banks were still, for the most part, staying home.
And what's wild is that the U.S. government actually set the stage for this way back in 1913 and 1919. The laws were on the books. But look at this timeline. By 1960, we're talking nearly 50 years later, only 8 American banks had even bothered to open branches overseas. 8! So the door was wide open, but it was going to take a pretty big shove to get them to walk through it.
So what was that big shove? Well, it was a classic 1-2 punch. First, there was the follow the customer strategy. After World War II, American companies started going global in a big way. Their banks basically had a choice: go with them or watch those customers take their business to a foreign bank. Pretty easy choice, right? But there was also a push from behind. Regulations back home, like this thing called Regulation Q, were capping how much interest banks could offer. So suddenly, those less regulated overseas markets started looking really attractive.
And what happened next? Whoa. It was an absolute explosion. Look at these numbers. The number of foreign branches didn't just climb, it went through the roof in just 20 years. That reluctant beginning? Yeah, that was officially over. This was a full-blown global gold rush.
Okay, so you've decided to go global. But it's not like you can just hang a sign in another country and call it a day. To deal with all the different rules and financial landscapes, banks came up with a whole toolkit of different ways to set themselves up. Let's pop the hood and see what's inside.
All right, take a look at this. At first glance, it looks like a total mess, right? It's this giant tangled web. You've got the main bank at the top and then all these other entities branching out. But as complex as it seems, believe it or not, every single one of these little boxes has a very specific job to do.
Let's start with the simplest tool, the shell branch. You can think of this as basically a post office box in a place like the Bahamas or the Cayman Islands. It's not a real bank with tellers and vaults. It's just a legal address, a booking office, that lets the bank take advantage of low taxes and friendly regulations. All the real decisions are being made back in New York or London, but on paper, the deal is happening through this shell.
Okay, next up is the real heavy hitter, the foreign branch. Now this is a proper bank. It's a genuine piece of the parent company just located on foreign soil. But here's the tricky part. It has to play by 2 sets of rules at the same time. A branch in London, for instance, has to follow British laws and U.S. regulations. It's a lot to juggle, but it's how a bank really projects its power internationally.
Then you've got this really interesting tool called the Edge Act Corporation. This one's kind of like the bank's special ops unit. It's a special subsidiary that gives American banks superpowers they don't have back home. The biggest one? The ability to actually buy ownership stakes in foreign companies. This was a huge deal because it finally let them compete with European banks who had been able to do that for ages.
And last in our toolkit is the weirdest one of all, the International Banking Facility, or IBF. Get this, an IBF isn't a place. It's not a building. It's basically just a different set of accounting books kept inside a U.S. bank. This little bit of regulatory magic, created in 1981, lets a bank in, say, Miami, do business with foreign customers as if it were offshore, meaning it gets to skip a bunch of U.S. regulations. It was a pretty clever trick to lure some of that international business back onto U.S. soil.
So, the banks have their tools, they're expanding like crazy, everything's looking great, right? Well, not so fast, because this brand new global playground came with some very new and very big dangers that the bankers back home had never even had to think about before.
The thing is, when you start lending money across borders, everything gets amplified. The potential profits? Huge. But the potential for things to go catastrophically wrong? Also huge. And we're not just talking about bigger risks. We're talking about entirely new types of risk.
It really breaks down into 3 main categories. First, you've got your normal credit risk. That's the easy one. Will the person you lent money to actually pay you back? But then, internationally, you have to add country risk. What happens if a government gets overthrown or there's a sudden economic crisis? And on top of all that, there's currency risk. The loan gets paid back, great, but if the local currency's value has crashed since you made the loan, you could still end up losing a fortune.
Now, back in the big lending boom of the 70s, bankers had this saying they used to comfort themselves, especially when they were lending massive amounts of money to entire governments. They'd say, nations don't go bankrupt. The logic was, a country can't just disappear like a failed company, so the loan has to be safe. It was a very reassuring thought.
The problem was, this whole philosophy was fueling the creation of a global system that was way more fragile than anyone realized. And it was about to get a very, very rude awakening.
And that reassuring thought, it turned out to be completely, tragically wrong. See, a nation might not file for bankruptcy in a courtroom, but it can absolutely just stop paying its debts. That's called a sovereign default. And when the Latin American debt crisis hit in the 1980s, that's exactly what happened. And that whole comforting idea was just shattered.
So as all this was happening, regulators were scrambling to keep up. One of the big moves was the International Banking Act of 1978. Now, this wasn't about U.S. banks abroad. It was about foreign banks setting up shop in the U.S. The goal was simple: make sure everyone's playing by the same basic set of rules. To level the playing field. But nothing, and I mean nothing, showed just how fragile this whole interconnected system was, like the financial crisis of 2007-2009. What started as a problem with home mortgages in America didn't stay in America. It spread like a wildfire through the global financial system, jumping from bank to bank, country to country, and threatening to take the whole world economy down with it. It was the ultimate brutal lesson in interconnectedness. So, knowing all this, how on earth do banks even manage this global gamble? Well, they have a playbook. They can bring in the third party for help, like getting loan guarantees or insurance. For really big loans, they team up and syndicate it, meaning a whole bunch of banks each take a small piece of the risk. And of course, there's the golden rule: diversify. You don't put all your eggs in one country's basket.
So what's the bottom line here? It's that the very thing that makes international banking so powerful is also what makes it so incredibly dangerous. This complex web connects the entire global economy, creating huge opportunities for growth. But that same web is what allows a crisis to spread from one corner of the globe to the other in the blink of an eye. It's a constant tightrope walk.
After 2008, regulators rewrote a ton of rules to try and make the system safer and stronger. But it leaves us with this one big question, doesn't it? In a world that's more connected than ever, where money moves at the speed of light, can we ever really make the system truly safe? Or is the next big crisis always just around the corner?